right, so we are recording. We've got Rob. Rob is here to learn the basics of trading, and so we're gonna go ahead and get started on learning that. First slide here, we have a candlestick. Rob, are you familiar with a candlestick?
I am not.
Not familiar. So these are two examples. Uh, Green means over that time period it went up,
Okay.
and red means over that time period it went down. So we call this a bullish candle,
Okay.
and a red is a bearish candle. So this is the creator of the candlestick. He was a rice trader in the 1700s, and he invented the Japanese candlestick.
Makes sense.
So you're probably a little bit more familiar with a line chart,
Yeah.
and so line chart over this time period it went down, then it shot up, and then it went back down a little bit. So this candlestick represents the same information. So here's the open. It opened at this time. It went down a little bit. It shot up. Then it pulled back some and it closed at this price. So over this time period, we can see that it opened here and closed higher on this bullish candle. So the one in the middle, that's a 5-minute candlestick. And so you can choose any time frame for your candlestick. And here, this is a 1-minute chart. So these are 1-minute candlesticks, and this represents the same information.
Okay.
So like it opened here, it went down a little bit. So this tail that's on the bottom of this 5-minute chart, it just occurred during this little moment right here,
Okay.
and then went up and pulled back, and we had a bearish bar during this time on this 1 minute, and then closed here. So that's a candlestick. As you kind of see more and think about it more, then you'll get a hang of it. So two critical things in trading. So the market is either in a trend or it's in a trading range. So this is an example of a trend. It's basically where the market's going in one direction.
Okay.
And so I see here, like one side is making money. So only people that are buying are making money. People that are trying to short the market or make money by going down, they're having difficulty. It's really hard for someone to short and to make money. Signs of a trend: pullbacks are small. So we only have several bearish candlesticks through here, and like I said, there's not much chance for the bears to make money. People shorting aren't really making money, so it's very one-sided. Another sign is the moving average is pointed up, and we're going to talk about the moving average later and explain what it is. But basically, it's these two lines I have on the chart. It's blue and yellow.
Yep.
And we can see it's pointed upwards. It's kind of in that diagonal, like sloped upwards. And trends tend to continue. So once a trend starts, it's more likely that it's going to continue doing what it's doing. So it's like a boat in the ocean, like a big like an oil tanker or something. Like it doesn't. If it's moving, no matter what they do, it's not just going to stop immediately. Like it kind of slowly stops and then reverses. So it's kind of like what a trend does. It there's momentum to it, and it continues doing what it's doing, and it takes some effort on the other side for it to actually stop.
Makes sense.
The other thing that the market can be doing is a trading range. So it's a more sideways market. It's where both sides are making money. So people that are buying lower in the range are making money, and people that are shorting higher in the range are making money. Pullbacks are common, and the pullbacks are deep. So we have several bull bars up here, and then we get a pullback, and then bull bar, but then this very deep pullback. And then notice the moving average, it's a lot more sideways than what the other moving average was. So it'll still have times where it's pointed up and down, but that's the thing, it reverses quickly, and it's pointed really in both directions. So like a trend, trading ranges tend to continue. So whatever the market's doing, it tends to continue doing that, and it takes some effort for it to stop doing that. And the market can be both. So this is that trend we were looking at on the previous trend slide. This area I have here highlighted, that's this here. This would be a 1 minute chart for this information here. So if you were just looking at the 1 minute chart over this period, you would say, well, this is a trading range, right? The market's going up, then it's going down, and it's up and then down. Both sides are actually making money. And so if you look at the 1 minute chart, then if you zoom out, you would say, well, this trading range is actually just a little bit of sideways movement in a much larger trend. So then if we zoomed out even more and looked at like an hour chart or daily chart where each candlestick was just a day, then we would probably see that this whole move is in a trading range, or maybe even in a bear trend, a downward trend. So you can always zoom out or zoom in and find examples of trends and trading ranges. Do you have any questions at this point?
No, I think all this makes a lot of sense.
That sounds good.
Yeah.
Next topic is support and resistance. So a support is like a floor. It's like a lower level that the market bounces off of when it gets to it. Resistance is like an upper level. It's like a ceiling. And when the market goes up to the ceiling, it kind of bounces off the top of the ceiling. So that would be resistance. Once it breaks out of one of these levels, it's like once it breaks above resistance, then that resistance becomes support. The market's above it now, and now this level is going to act as a floor. And kind of like what I was talking about with trends and trading ranges, they tend to continue what it's been doing. So once it's above it, this means that something different is going on. So now this resistance acts as support. So this level holds up, and it continues to hold up. And let's say we drew the line way out here. If the price was coming back to it, it once again would act as support, even way over here. So we could like drag it out like this, and if that market fell back to it, you'd be likely to see some sort of effect when it gets down here. It might not necessarily bounce strongly off of it, but sometimes it does. But oftentimes you'll see something like it reacts to this level once it comes back there. So we have different types of support and resistance. First category, we have double top and double bottom. So here's an example of a double top. The market went up to a level and it pulled back. And then it went up to that level again. So whenever you see the market go to a level twice, then we call that a double top. And notice after this double top, market sold off. Double bottom is the same thing, just reverse. So market came down to this level here, pulled back, and it tested it again. And so from this double bottom, the market reversed up. We have another example of a double bottom here. Came down, pulled back, then came down to the same level here. However, this double bottom didn't hold up, and it ended up falling out below that double bottom. So those are double tops, double bottoms. So these are pretty important. A lot of my trading is based off of double tops and double bottoms. There's also prior highs and prior lows. So this is the highest price of the chart until we come back up to it over here. And look how the market stalls here. It's clearly reacting to this prior high. So this prior high is acting as resistance. At some point, this was the fair price. Like there were buyers and sellers at this price right here, the reason they were buying and selling, they were agreeing that this is the correct price. So when the market comes back to it, there's a good chance that they're going to find that as a fair price again, and it's going to act as resistance there. And you can see, kind of tested it a couple times, played around in that area, and then fell down a little bit. We also have prior lows. So as the market's moving up, it creates these lows here, like here and here. As the market fell back down, prior lows act as support. And we can see the market bounced off of this prior low here. Another type of support and resistance is indicators. And an indicator, it can be pretty broad definition. It's basically anything that you add to the chart. And so an example of that is the moving average. So here I have the 20 exponential moving average. And on the next slide, I'll explain the moving average, but you can see this blue line. You can see how the market reacts to this blue line. So here it's pulling back, and you can see this little bounce that happens at the moving average. It gets below it here, and with a little bit of imagination, you can see how it's trying to get above it here and can't, and trying to get above it here and can't, and ends up selling off. Tries to get above it here and can't, and sells off. It does manage to break above it here, and then look at what happens the first time it pulls back to it. It bounces off of it here and goes higher. So moving averages are something that I have on my chart, and this is the main indicator I use. But there's a very broad set of indicators that not only act as support and resistance, but also actually give you like entry signals. They actually tell you like when to trade. That's not what I use though. I'm comfortable with just using moving averages. So what actually is a moving average? So moving average, it's the average of the last so many bars. Specifically, like if you take the closing price of the last 20 bars and take the average of that, then that is the moving average. So in blue, the blue line is the 20 moving average. So that takes the average of the last 20 bars, the last 20 closes of the bars, and it plots it on. And almost like magic, these, just by doing that math, it acts as support and resistance the whole day. The higher the moving average, so this is the yellow is the 200 moving average. So that's going to act as a stronger support and resistance. And I have these black lines that show where it tested the 200 moving average and bounced off of it. So here, it's pulling back, bounces off of it there before it breaks down, bounces off there, breaks through, then pulls back, tests it a couple times here, it breaks through, then pulls back and tests it before going lower. So it always surprises me how often the market respects these moving averages. And really, this is just something random that we just put on the chart, right? But but other people have these on their chart as well, and it kind of brings it to life. Like people recognize it, so therefore it becomes a real thing on the chart. Like people place their orders around here at the moving average. So it's kind of like a self-fulfilling prophecy.
That makes sense.
So there's a simple moving average, which is just each bar is weighted the same. So it's really just the average of the last 20 bars. I prefer a 20 exponential moving average. So it basically just weights the more recent bars heavier. So it still takes the average of them, but it puts a higher weight on the more recent bars.
Okay.
It really doesn't matter what moving average you use, as long as you understand how the market reacts to it and you're familiar with it, then that'll be enough. But I prefer these 20 and 200 because those are a couple of the more popular ones. And it gives me good context. It gives me kind of the 20 is more of a shorter time frame moving average, and the 200 is more of a larger time frame, and I like the context that it gives me throughout the day.
To have both together.
Mm-hmm. So, uh, trend lines and channels. This is something that we draw on the chart. So we can see the market's moving up here, and if you start drawing lines on your chart, you can see that it is actually significant. So we take the low here and draw a line up through these lows, and once that gets extended out, you can see the market continues to react at that line. Once you have your, so this is a trend line, then once you have that in, you can copy and paste it, put it up, and this is your channel line, and now you have a channel. And so the idea with the channel is that you look to try to buy lower in the channel and sell once it goes higher up in the channel. 75% of breakouts below a channel will test the top of a channel. So we can see here it broke out below the channel. However, this is the 25% of the time where it did not come back up and test the highs. So that's a low probability event, and when you get low probability events, it often leads to strong moves because it's a surprise. When it breaks down here, usually the market will come back up and test somewhere up here, but this time it didn't, and that's a surprise to the market and the people that are trading. And you can see we got a fairly strong sell-off out of that. Another way to look at this is, actually I think I have it on the next chart. So this is the same chart. I want to look at here is the breakouts. So I have the breakouts drawn in these this kind of blue box. We have this. So this is a bullish bar. It is breaking out above the high. It's doing something different. It's been somewhat sideways here. And now it's doing something different, and it's breaking out and it's closing above the high up here. So that's a breakout. It's breaking out above this trading range. It's breaking out above this high. Over here, we have this big bear bar. So I'll ask you, what is this bear bar breaking out of?
What are you talking about? The support, or is it like a? I'm sorry, I don't know.
So I would look at this as breaking out of this channel.
Mm-hmm.
Yeah. So it can break out of like prior levels.
Okay.
Breakout could also be of something like a channel.
Yeah.
So breaks out here and fails to go higher, then sells off. So once you get a breakout, sometimes the breakout will just continue and it'll just go straight up, kind of like how this just went straight down.
Okay.
A lot of the times you get these pullbacks. So breakout, market pulls back a little bit, and pullbacks create entries. So breakout, pullback, and then I have these green boxes marked where people will be buying above those bars. So people will be buying here. So breakout, pullback, they'll be buying here. And as this, right, we kind of get a move back to the channel here and another good looking bull bar. It's closing near its high, and people will be buying above that as well for it to go higher. Over here, we have a breakout, and we actually had a couple pullbacks. So it tried to pull back here, tried to pull back here, and we got this big bear bar. People will be selling below that and we can see they were able to make money by selling below that. And pullbacks are attempts to reverse the trend or the breakout. So these attempts to reverse this breakout, they're trying, but they're failing. So they try here and they fail. They try here and they fail. And when the market's trying to do something a couple times and fails, it often just ends up going the opposite way. So that's what happened here. So how do we actually take trades? How do we actually get in and make a trade? Well, there's three types of orders. The first is called a market order. And basically this is just like, there's a button on your screen that says buy or sell. If you click that sell button, like if you sold here, it will just find the best price and it'll fill your order. So you're a seller, it'll find the best price for you. Basically, it'll find the highest price that someone's willing to give that order to you for, and you'll be filled. The issue with this is you could lead to slippage, because basically when you're doing a market order, it's saying, you're saying, I want to be in the market, I want to have a position now, find me the best price and get me in it. But that best price might not be actually a very good price for you.
Mm-hmm.
So this is why you only want to do this if the market is liquid, if there's lots of orders in it, like if there's lots of people in it, lots of volume. If there's not, you're at risk. Like if you're trying to sell and there's no buyer, like if you're trying to sell here and there's no buyers until down here, then you're actually going to end up selling at this like lower price.
Okay.
Because that market order is just going to force it to find whatever the next price is. So market order it'll go ahead and just get you in at whatever price the market is at, which is fine if the market is liquid. But if the market is not very liquid, you could get an unfavorable price. So this is a stop order, and for stop orders, you basically place it where you want to enter a trade. So here I have an example. There's two big bear bars. Market's probably going lower. I want to sell here if the market goes below this bar.
Mm-hmm.
So once it gets to this price, it triggers a market order. So you're basically just like, a stop order is basically placing where you want a market order to take place. So I want this to take place here. I want to get in the market if it goes below this bar.
Okay.
And I have several other examples where I'm basically selling below bars here. A couple strong bars down, pullback, good looking bar, probably sellers below that, probably going lower. Another strong bar, probably going lower. We have a pullback. I mean, there are some bull bars in it, but these bull bars are not big enough to offset all of this selling.
Yeah.
So this is probably a pullback that's just going to fail and lead lower. So probably sellers below this bar here. Once again, because it's essentially just making a market order, there could be slippage, and you could be given an unfavorable price if there's not very good volume at that time. So the last order is a limit order, and this you will only be filled at the price that you set or better.
Okay.
So the risk of the market order is that you could be filled at some price that you really don't want. Versus limit order, if I'm selling here, so two big bear bars, you have this little bull bar with a tail on top. Right, this is not enough to offset all of this selling. So there's probably going to be more sellers above this than buyers. So people will be, so once this bar closes, they'll put limit orders above this to sell. And if it goes above it, they'll be filled at that price. So there will not be slippage. You will only be filled at that price. However, you might miss some trades, because let's say you're trying to sell here, but if there's not that many people wanting to take the other side of your trade, if there's not that many buyers, you might not even get filled. So you might miss like these shorts here. this bar is a similar situation. Probably sellers above this bar. Well, here, it might not have gone high enough to actually fill your order. So you might have missed that short as well. That's kind of the trade-offs. To me, the best type of order is a stop order. It's best to try to, right, I can see the market is going in this direction, and I want to be in the direction of the market. So the advantage that this has over a limit order, if I'm like selling up here, well, if I'm selling up here, that means the market is actually moving up. So I'm trying to sell into a market that's moving up a little bit. So I think for people that are starting out, they're going to be better off trying to do stop orders and just focus on staying in the direction of the trend. And there's two types of trades you can take. Basically, there's a scalp order where your profit is less than your risk, and there's a swing trade, which basically means your profit is greater than your risk.
Okay.
So this is an example of a swing trade. If I'm selling below this bear bar, my entry is right here, and I'm going to put a stop order above this. And so this is called a bracket. So when you put your entry in here, you're going to put your a stop up here, and that means that you will exit the trade if it goes up here. So you're going to lose a little bit of money. So basically, if it goes up here, you were wrong, and you lose that bet. So that's what a stop order can both get you into the trade, and then, right, this would be like a buy order, a buy stop order. So if it goes up here, I just want there to be a market order. I just want to be out of the trade. So wherever you place your stop, if you're swing trading, you're going to go for at least 2 times your risk. So we can see I sell here. Here's 1 times my risk, and then 2 times. And you could hold for longer and try to get out down here. So in a swing trade, you're holding it for longer. And beginners should focus on swing trading. It's good for them to try to. It's good. It's going to be a good experience. They're not going to lose very much relative to their profit potential, and they're going to learn a lot by trying to stay with the trend and stay in that direction and try to maximize their profit from the trend. So advanced traders also, so beginners should only do swing trading. Advanced traders have a wider range of trades they can take, but they also could just swing trade. To be an advanced trader, you don't have to take other trades on the next slide that I'm going to talk about. Like, advanced traders can just do this and they can make plenty of money, and many advanced traders do still just swing trade. A scalp trade is where your profit is equal to or less than your risk. So if we're selling here and trying to go for profit here, that's a scalp. And you could even go for half of your risk here. So instead of 1 times, let's say you go for half or a quarter of your risk. So that would be a scalp. You're just going for small profit. You're holding it for a short time frame. So what you gain out of this is high probability. Your odds of making profit here are higher than if you put your profit down here.
Mm-hmm.
So you're more likely to make profit, but your profit's going to be smaller. One of the reasons beginners should avoid doing it is because it requires more experienced management. So if the trade's going against you, you need to do more work to be able to manage it correctly. These trades require high probability. So if you're not actually, because your risk is equal to or larger than your reward, you have to actually be winning the majority of the time. And if you're not good enough to win the majority of the time, then you're going to lose. So beginners should avoid scalping. So we have this trend down, and these red boxes are areas where people might scalp. So they're shorting and they're scalping. So basically here, I just marked all of the, anytime there's a bull bar, there's going to be people selling that close. Because when it's in this downtrend, people will, basically any pullback is likely to fail. Any attempt to reverse this trend is going to fail, and the market will continue lower. So these red boxes are those little scalps. So people will sell, and then they'll go for a small profit. And they'll collect all these small profits throughout the day. And at the end of the day, they can say, oh, I made a lot. And, all of my little small profits added up. So that's different from what a swing trader might do. So a swing trader might sell once here, and then they'll go for like 5 times their risk. So they'll sell once, and then they'll make all this profit at 5 times their risk. So what's going to be easier for a beginner to do? It's going to be easier to try to swing trade. Now, I think like a really strong scalper can make as much. So like if someone's really good at scalping, they could make as much as someone that just went for one swing trade. So at the highest levels, it kind of evens out. I think people, even though it's not for beginners, people want to be able to scalp because, well, it's fun to be taking lots of entries. You're feeling more active. You're doing more stuff throughout the day. You feel like you're actually like kind of earning your money. And it's fun to be like right all these times. But it's going to be easier to swing trade and take one good trade and try to go for a large profit, because you're taking advantage of the nature of the market where trends continue. So if trends continue, you want to be in the direction of the trend. And another thing on swing trades, people kind of have different definitions on scalping and swinging. So when I'm talking about it, I usually mean like a 5-minute chart, like intraday, like a few minutes to like a couple hours. And really, for me, a scalp or a swing trade is just, am I trying to win like $100 might be a scalp, and a swing might be like $1,000. Other people will talk about it more in terms like of being on like a daily time frame. So they'll say a scalp as something that's intraday, like a trade might last a few minutes to a few hours, and someone else might call a swing to be something that lasts several days or several weeks. So so basically just kind of use the context of the conversation to know when they say, oh, I swing trade. It might mean different things. So use context of the conversation, or like ask them like, oh, do you trade on a daily chart, or do you like a 5-minute, like what's your time frame? And that'll kind of give you the answer to what they mean by swing or scalp. Any questions so far?
No, I think this.
You're soaking it. You're soaking it all in. So legs and measured moves. Markets will have strong moves down, and we call that a leg. So this here would be the first leg. And you can see we just drew it from the high to the low of this move. Then there is some sideways movement here. One way you can try to predict how far the market's going to go is by copying this down and then placing it at this pullback. And you can see the market had a leg 1, pullback, leg 2. And then once the market reaches this level, it acts as support. So ways you could look at trading this would be, we have a strong move down, decent chance we're going to get a second leg down, so I'll try to sell below bear bars like here, and I probably put my stop here, and just go for 2 times my risk and try to get out somewhere down here. I'd try to get out before it would gets down to this measured move, this leg 1 here, this leg 2. Here's another example of a short. We've broken out below this level here, and now this level is acting as resistance. You can see the market's trying to pull back and is testing it. So now we're below resistance. Oh yeah, we're below resistance, and we're getting a good bear bar. And there's a target below, which is this measure with this leg 2. So probably a decent place to sell there. So another way you can try to find where the market's going to go is doing a measured move. So we have a trading range here, right? Markets has lots of sideways movement. These breakouts are failing. From the low of this trading range to the high of it, we can draw a measured move up. So just copy that distance up, and it puts you up here. Once the market breaks out of this range and starts to head higher, then this measured move becomes a target. So the market wants to see what's up here. And so this is actually the daily chart for gold. And back in July, I was making videos about how we were likely to get a breakout here, and if we did, we would get a measured move up. That'd probably lead us up here. And so that's what occurred. And I have these buy entries here. So breakout, pullback, and then some people will buy above this, trying to go for a swing trade to get out up here with this large profit. Others will wait for more of a double bottom. So we can see we have some sort of double bottom there, maybe even like a triple bottom. And then we get bull bars. People will buy above that. Breakout, pullback, good looking bull bar. People will buy above that. And then we can see gold, once it got up here, it reversed down from that measured move target. Kind of the inverse of a measured move is a 50% pullback. So the market had to move from this low up to this high. And then if you look at what's halfway between that, a 50% pullback, the market came back down to that and tested it there, and it bounced off of it and headed higher. Same thing here. We have a low and a high, so a strong move up. That pullback came back to the 50% pullback before we're heading higher. So markets often react at these 50% pullbacks. So, it could be kind of a philosophical question, or you might say, like, okay, so I get that there's math involved, like it's 50% back, but why does that work? Like, what's actually happening to make that work? Well, what people will do, let's say the market's going up, they will buy the close of bull bars. So they'll buy here, or they'll buy here. And one way that they manage their trade, if it's going against them, so instead of getting out, they'll just hold their position. So they'll stay long, they won't sell. They'll hold all through this, and they'll wait to buy above a good bull bar. So this is called scaling in. So they'll buy here, they'll buy more here, and then that means their average price, their average position is going to be right here in the middle. So you have buyers here. As the market pulls back to that, a lot of the people that bought here and bought here, they're break even now. So they're like, we're lucky we were able to hold on, we bought more, and now it's probably just a good time to go ahead and break even and call it a day on that trade. And you can see right at the midpoint of those two levels, people sold that level. People that were long, they ended up just getting out of their position, so that created selling, and we see it stopped at that level and pulled back. it's another reason to buy here, double bottom, and it's a good looking bullish signal bar. So that's kind of another reason why they might like to scale in here. Another pattern to look out for is a head and shoulders. So kind of move these out of the way. Head and shoulders. Think about it like a person. We have a left shoulder, we have a head, and then a right shoulder. And head and shoulders patterns are reversal patterns. So what's going on with this? Market's moving up, then it pulls back, and it finds this resistance at this level. For whatever reason, it was trying to go up here and it couldn't until it breaks out. Then this high point is the head. The market pulls back below this prior resistance level. And once it does that, it tries to go higher again and fails at that resistance level. So that kind of finishes off the head, the left shoulder, head, and right shoulder. And we can see reverse down from there. A good looking bearish signal bar. People will sell below that bar, betting on lower prices after this reversal pattern. Over here we have a head and shoulders bottom. So left shoulder, and for whatever reason the market bounced at this level, broke through, pulled back pretty deeply and retested this support level, and that support level held there, and then maybe call this a double bottom and bullish signal bar, couple good looking bull bars, people bought, and it reversed and it went up. So head and shoulders are pretty common, and they are reversal patterns. Last thing we've got is triangles. Kind of move that out of the way. So a triangle is a trading range, but it's contracting. It's where the highs are getting lower and the lows are getting higher. So anytime you can draw like a line going down and a line going up, then you can call that a triangle. Now, the first breakout of the triangle often fails. So we can see here, triangle breaks out. Instead of just immediately selling off, oftentimes it'll come back to the apex of the triangle, right to the middle there. So you want to look for the breakout, then you want to look for it to retest before trying to find another entry. And we can have larger triangles going on. So you have this smaller triangle. It never really broke out of this area and ended up just creating a larger triangle, yeah. Here broke out of this, you could call this a breakout and then pulled back to the middle before heading off. Or you could call that this is the breakout, then this is the retest, and then it heads off higher. So different ways to look at it. And if you're trading a triangle like this, a swing trade is better because, one, you can see how much uncertainty there is, so your odds aren't going to be that high, right? I mean, is this the breakout that's going to work? No. Is this going to go down here? No. But that you end up being able to buy here or here, and it works. So your odds aren't that high, but when it does work, your profit potential could be quite large. So that's why swing trading is better, going for profits larger than your risk. And there we go. That is your introduction to trading.
Thanks, Guy.
You're welcome. Any thoughts? Any questions?
I think this makes a lot of sense. Now I just need to kind of jump in and start trying to make some money.
Sure. All right. Well, go ahead and end the video. So Rob, thank you for sitting here, and I will go and set up your Ninja Trader after this and get you going.
Awesome. Thanks, guys.
Okay.
Appreciate
All right.
you.
I hope you guys enjoyed that. This is a beginner video. Let me know if you guys have any questions, and I'll see you next time.